All right, everybody, Stocks by the Numbers. Welcome back. Today's Wednesday. It's midday. It's about 2 o'clock in the afternoon. Wanted to do a video here on Intuitive Surgical Incorporated, ticker symbol ISRG, listed here on the NASDAQ. Now, this company has been flying over the years, and with good reason, in my opinion. The numbers seem to be very solid, very stable, very consistent. As we see, ticker symbol ISRG here on the NASDAQ. Stock right now, $370.74, down about two-thirds of a point, about 0.2% here on the day. This is showing a high of 384. This candle right here showing a high of 385.5. So I'm not exactly sure what to make of this situation, but long story short, the reason why we like it is the consistency in the numbers. As you see, the company posted earnings yesterday after the close. So I know I'm coming to you a little bit late here, but I was very curious to see how the stock was going to react today after these numbers. Because again, the company comes in above analyst expectations, which is basically what they do for a living. As you see here, coming in above analyst expectations on the EPS side by almost 8%, coming in above analyst expectations on the revenue side by over 2%, posting $1.928 billion on $1.888 billion. And the company consistently does that if we look back. But first, I want to look at what a couple of the big boys have to say about it. As you see here, ISRG maintained outperform at RBC. Stifle bumps up the price target from 360 to 420, maintains buy. Deutsche Bank increases price target from 275 to 370, maintains hold. And again, anytime an analyst comes out, puts a hold rating and their price target at the current stock price, I mean, what do we need you for, right? But I guess Deutsche Bank just had to say something. But Truist, as you see here, increases price target from 390 to 435, maintains buy rating. Morgan Stanley adjusts price target from 330 to 375, maintains equal weight. Barclays increases price target from 385 to 430, maintains overweight. That one I agree with so far the most. BTIG raises price target 412 from 392, maintains buy. JP Morgan raises price target from 3.25 to 475, maintains overweight rating. Piper Sandler raises price target from 3.25 to 4.25, maintains overweight rating. So as you see here, RBC raises price target from 400 to 435, sees quote unquote substantial upside potential ahead, keeps outperform rating. And also we have the next generation robot coming out here for Intuitive Surgical. So overall, the company really has been doing very well over the years. And if we pull up even like a 5-year chart, you can see how much the company has grown here, going from, $150, $160 a share. As we see, we're approaching almost 400. And if we pull out an all chart, obviously, it's just ridiculous. But I just wanted to show you some of these trend lines here, going from these lows, February 3rd, 03, it looks like. And I just drew that trend line up to connect to that low right there, October 3rd, 2022. And I believe that is that trend line there. And then we have this trend line recently. Let me zoom in a little bit here. And I'll show you. This is from the low there as well, October 13th, looks like, of 2022, coming up to the low there of October 30th in 2023. So that looks like, in my opinion, just going back just the last 1 or 2 years, this now seems to be our support trend line, okay? And that's why, in my opinion, if we do happen to break this trend line back down and we do happen to chunk back down, we could potentially see the low 300s here. However, overall, in my opinion, the company does seem pretty fundamentally sound. So even if we begin to piece our way in here at 370, if we drop down into the 360s, if we do happen over the next 2 months, 3 months, have a pullback down to the low 300s, in my opinion, you're probably just buying a $400 stock over time, and you're buying it for a nice discount there at about 300 and change. But we'll see what happens. But as you see, the stock looks like it topped out here November 8th, 2021, connecting to, I believe, the top of that candle right there, December 29th of 2021, drawing across, connecting to that high there of July 19th, 2023. And you can see that with the markets consistently increasing, basically all the time, and of course on anticipation of earnings coming out, we had a lot of momentum come in to the stock, and you can see that it pushed it above that top resistance trend line. So now we have to see if it holds this trend line. We could easily retest like this fib down here, 356, 355, and we could retest this line. But if we break that line, then chances are we could potentially have a gap fill or a pullback here to this 1-year fib of about 338. So we have to see how the stock is going to perform from here. However, technically getting above this top resistance trend line here technically is a bullish signal, but I just wanted to draw out a couple of trend lines so that we could see again where we could potentially pull back to slightly, and then if we break, where we could pull back to. But overall, we just have a lot of upward momentum here, and even the top trend lines as well. Let me back this up a little bit more, and you can see that I'm going from about December 3rd of 07, and I connected to that top right there of April 2nd, 2012, and you can see that's the line that kind of cuts through there, this long red line. And then what I did was I went from that same top there of April 2nd, 2012, and I just connected to that top right there of about September 4th, 2018, and drove it through. Now I understand it's not technically coming and touching the top of those candles. However, you can see that it is a key line as the stock consistently bounced off that level multiple times. So now that's why, in my opinion, that could potentially be the top of our range here, right? And if we jump up here, you can see we're looking at, 450, 460, 480. And of course, we're going into April, May. So that's why I'm saying, in my opinion, the company could easily get well above $400 a share. Of course, even if they, as long as they consistently beat earnings and keep growing their business. But we have to wait and see if it does hold that this top resistance trend line here. But overall, company doing very well again, as we see, beating earnings. But coming down here, we can see the company has a market cap right now of about 130 billion and change. We have a PE of about 74, right? So on paper, we could be viewed as overvalued, but the track record is pretty impressive, as we see, consistently beating for the last 4 quarters straight on the EPS side. If we look annually first, we can see, look at this, less than $4.5 billion in revenue back in 2019, dropping down to 436 in 20, and then up to 571 billion, 6.22 billion, 7.12 billion here in 2023. So the growth of the business cannot be denied. I can appreciate the fact that the profitability has taken a slight percentage hit here over the last 4 or 5 years, going from about 30 and change, trying to reclaim it, and then dropping down to 21 and a quarter, 25 and a quarter. So looking annually, it does, you could say, profitability has been stepping down. However, if we switch over here quarterly, we can see the exact opposite story. First of all, the revenue 166 billion up to 176 billion, 174 billion, 193 billion as of what they reported yesterday. Phenomenal quarter here, in my opinion, for ISRG. But look at the net margin percentage, right? The actual profitability from said revenue, and you can see that it was sub 20%, jumps up to almost 21, almost 24, maintains slight sub 24. Now, as of last quarter, jumps up to 31.44%. So if they are turning the profitability around with, of course, the consistent increase in revenue quarter over quarter, year over year, in my opinion, probably going to be a recipe for success. But when we deal with a situation like this, especially with it trading near these highs, whether it's justified or not, in my opinion, we have to piece our way in. That's why I specifically use that terminology. In my opinion, with something like ISRG, regardless of how good it looks, you should be piecing your way in. If you go all in here at 370 and then, markets begin to sell off and people see ISRG as like easy pickings because it's overvalued in the numbers, so they're just going to pile into the puts, pile into the shorts, and cover it down here at this bottom trend line here at 303 or something like that, then obviously if you take the position here, you're going to take a substantial percentage hit, and you may get emotional, and you may go down that negative path of, I don't know what I'm doing, I always buy at the wrong time, whatever, I'm just going to sell, I don't want to lose all my money. Meanwhile, again, if you simply began accumulating and building a position and piecing your way in here at 370, if it drops to 330, that's even better for you, because as we always say, if we liked it at 370, we're going to absolutely love it at 330. So obviously you accumulate more shares on the way down. And, that does a couple of things, because if we again feel that a situation is very fundamentally sound, then we're going to want to consistently accumulate shares and build a position over time. But also, that's what, the dollar cost averaging really is. We begin buying at 370. If we pull back here, all of a sudden it's 352. Okay, I'll buy more shares, lower my cost basis. Now it's down to 328. Okay, I'm getting upset. It doesn't make much sense, but we know that the company seems to be fundamentally sound and is consistently growing. So I began buying up in the high 300s, so I'm just going to keep buying down here in the low 300s. And not only does that basically increase your size of the position, obviously, every time you buy more shares, but of course, it lowers that cost basis down. So even though you began buying here at 370, if we do pull back to the low 300s over the next several months, but you're consistently piecing your way in, then, at the end of that sell-off, when the U-turn when the U-turn begins and the recovery actually takes place, you're going to have a cost basis of 340, 337 or something like that. Your cost basis is not going to be 370. And that's why I say, unless you're really banking on an earnings report, or if you're just hoping that an announcement is made today in the company's favor in regards to some sort of litigation issue or something like that, right? Kind of like what we saw with Coinbase that time when the stock popped up. So, unless you're really, confident in a positive catalyst like that coming out on a stock right there in the very near short term, in my opinion, you should never really go all in, because anything can happen, right? So if you're asking me, if markets begin to sell off, can ISRG go down? Abso-freaking-lutely. And that's why I'm saying you should never really go all in. But ISRG really looking good, not only in the numbers, but here in the chart as well. And I'm curious to see if it does hold this top resistance trend line here. Again, that is connecting the tops of November 5th, 2021 to, I believe, December 28th of 2021, coming down to this candle here of July 19, 2023. This was the last split, as you see, going back to October of 21, 3 for 1, right? This is the opposite of a reverse stock split. Reverse stock split, they give you 1 share for every 50, 100 shares you have. Regular split, they're giving you 3 shares for every 1 share you have. So that's the last time the company split, but just wanted to bring it up just because I saw it at the bottom of the screen. But overall, I feel we do have a lot more positivity than negativity. And the PE could be viewed as high. However, again, there's a NASDAQ-listed company, right? And we love our tech. Our tech, all of our tech is really going to the moon. It really doesn't matter what the company does. If there's a computer in the freaking office, the traders are going to take the stock to the moon. So we're really rewarding these tech stocks. And again, we could have a big sell-off here, potentially back down to the low 300s and get back into this triangle range. But again, overall, in my opinion, if I liked it here, I'm going to love it down here. And this would be something that I would probably piece my way in and accumulate over time. Again, these numbers cannot be denied. The profitability has turned around. We'll look at the financials very quickly. I was looking at them before. It seems like it wasn't really updated here on TradingView, but overall, I just wanted to show 3 of the last 4 years, right? Beat on annual revenue, beat on annual EPS. Look at the debt of this company here. We're talking tens of millions of dollars here. Literally a drop in the bucket. The company's sitting here with cash on hand like crazy here. Look at the cash and equivalents here over the last couple of quarters. 1.58 billion, right? This big dark blue bar I'm looking at, by the way. 1.58 billion, 2.14 billion, 3.44, 3.6 billion. Zero debt. This is showing me here for 2023. And honestly, even if that debt isn't accurate, even if it's 100, 200 million, the fact that this company's debt is so low, with such positive cash on hand, with consistent growth in revenue and profitability quarter over quarter, year over year for the most part, that's why, even these slight negatives or red flags, as we say, really, I don't think outweigh the positives. I really think the positives are significantly outweighing the negatives here. The only thing that does scare me is the fact that the market cap to annual revenue comparison does seem like a pretty high multiple. And that's why I'm saying we could potentially pull back below that resistance trend line, that top resistance trend line we looked at, and we could begin to sell off and drop down into the mid and potentially low 300s. But again, if we liked it at 370, 360, 350, we're going to love it at 330, 320, 300, right? But here you can see, obviously, as revenue consistently keeps increasing, we have the cost of goods increasing. Revenue minus cost of goods gives us gross profit, as you see, has been consistently increasing. Operating expenses, of course, consistently increasing as well. However, now the company jumped up to the next level here when it comes to operating income. As you see, for about 4 quarters in a row, we're kind of maintaining like that 370 to 390 million range. Now, in the last 3 quarters straight, the company has jumped up not only into the 400 millions, but has maintained 450 plus million for the last 3 quarters in a row. So that's why they're doing something right. They're not only consistently increasing their footprint, their market share, and their business overall, but of course they're beginning to turn around the profitability as well, which of course is a very good thing. And again, a company like this having, a couple of $100 million or a couple of billion in cash on hand, obviously it comes in handy down the road if for any reason the company runs into any negativity, any speed bump. Obviously they have a couple of bucks on the back burner to try to help them get through the situation until they can right the wrong. Or of course on the flip side, if there is any small or micro cap company up and coming in the space, obviously they have the cash on hand so they can step in, make a nice quick acquisition, and move on to bigger and better things. But seems like the assets have been consistently growing. I know the liabilities got up to about $2 billion, but we can see that the equity now has jumped up and is now above $13 billion here. And the book value per share, again, not showing us here, but as of last quarter, up to 35.62. So it does seem like overall we have consistent growth here. Look at the growth here from 2017. Book value 14.18. Now we're above $30. I mean, very, very impressive here. And looking at that, again, I know that could be viewed as a red flag as well, right? You're telling me the company has a book value of like, what, $34, $35 a share as of last quarter. Stocks trading 10 times that. Totally understandable. However, we've had companies that, in my opinion, didn't have that same consistency and actually have been proven to be a little bit more inconsistent, but they were trading at insane price to book ratios. So that's why I'm not really sure if I can view that as a red flag. But again, just to show you, market cap 130 billion. As of last year, $7 billion in revenue, right? So we are trading at a pretty high multiple of annual revenue to market cap comparison. So that's why I showed you guys that top resistance trend line here. And I'm glad that the stock jumped up for those of you who own it. But again, if we retest and happen to break this line, we could seriously chunk down quick. And as rough as it may sound, it actually may be justified. But again, like I always say, some of these stocks that, just consistently climb into the stratosphere, but have the positive catalyst and the numbers to back it up, sometimes they do have to sell off and come back down to earth, go into some downward consolidating channel, and then that's when they pop out and take that next leg higher. But overall, does seem like a pretty positive stock here. Again, the PE could be viewed as a little high here at 74, but as you see, we were a couple of quarters ago, we were up to almost 86 on the PE side, and looks like the stock really isn't really going below a PE of about 50 and change. So, of course, that's a big drop and a big sell-off from here, but what it's showing us is over time, historically, the stock trades at a high multiple to earnings based on their consistent growth, in my opinion. That is why I feel that Wall Street is keeping them up. As you see, going back to 2017, lowest PE was 50.44, right? So, of course, we're higher than that. But look at the highest point here, as you see, almost up to 93, right? So if we do the math, 50, low of 50, high of 93, if we do the math, this 73, 74 mark is kind of in between that low and that high of the range, right? So we're kind of right at that mean average right now. So, of course, we could go higher from here. We could go lower. But again, in my opinion, I think it's more about that top resistance trend line. I think that's what we have to keep an eye on. Trading here, 18.67 times sales. Not the lowest it's been, as you see, was 13.5, 15 and a quarter, right? It's up here at 18, and the highest it was, we have 22.5, we have 23. So again, we're kind of like in that median range there. trading about 10 times book. Return on assets made a little bit of a rebound the last quarter. Return on equity, the gross margin percentage has pulled back here to the 66s, which isn't the lowest it's been. As you see, it touched the low 65s, but before that was 69, 67. So in my opinion right there, that could potentially be viewed as a slight red flag as well. I don't necessarily think that could be the main catalyst reason as to why the stock should, justify a 15, 20% sell-off. I'm not really sure if that's what it was. If it was such a big deal, they would have destroyed it already. Right? That's the gist I'm getting. And again, I have to go back to even something here like the operating margin, the fact that it was in the 30s and it pulled back here to the mid 20s, right? And technically has been slightly dropping for the last couple of quarters. If it was that big of a deal, they would have hit it already, right? And I always bring up PayPal again, PYPL, PayPal. That company came in above analyst expectations on the EPS side and on the revenue side, beating earnings again. And the stock absolutely got decimated and went from 70 down to 50 and hit new lows because the operating margin percentage came in at 21.4% instead of 22% as analysts expected. So they decimated the stock, dropped it, 20, 25%, had it hit new lows, all for missing the operating margin percentage by 0.6%. So the fact that we've dropped, 1, 2, 3 percentage points here on the operating margin over the last couple of quarters, but the stock opened today at new highs, 384, 385, whatever the heck they were, tells me that, in my opinion, that is not the negative catalyst that would bring down the stock. Net margin percentage, we looked at the profitability before, as you see, was in the low 20s, got up into the 30s, back down into the mid 20s, back to the low 20s, and now as of last quarter, 31.44%. So it does seem like they're turning that profitability around. This, in my opinion, could be potentially viewed as a red flag. However, I'm not necessarily sure how weighted this information could be, because of course I understand, it is a fundamental metric and it's listed here. So, it's something to look at, something to keep an eye on. But the difference is, also, even though the inventory turnover, as we see, kind of has been consistently decreasing, the revenue has been consistently increasing, right? So that's why I'm not really sure how weighted a lot of these metrics are, because the proof is in the pudding in the actual business here, showing consistent revenue growth. But inventory turnover, as you see, 3.9 down to 3.5, 2 3/4, 2.5, back up to almost 3, back down to 2 3/4, now about 2 1/4. Right? So that's why, again, this could be viewed as a red flag, but if it really was a red flag, I think, in my opinion, they would have beat the stock up already. And of course, everyone and their brother wouldn't have come out and, maintained buy and overweight ratings and increased their price targets, right? They all would have addressed it more than likely. Asset turnover, as we see, got up to 0.55, slipped down into the low 0.4s, and has been consistently climbing for the last couple of quarters, now back up to 0.5. Overall, in my opinion, this is the type of company that you want to own. And that's why I always say, when it comes to the, when it comes to these longer term investments, you, first of all, in my opinion, you have to do your own due diligence, of course. But second, this is why I specifically use the terminology piece your way in, because again, at any moment, the stock could sell off and begin coming back down to earth. And the last thing you want to do is have a cost basis at 370, have the stock, get hit with a massive sell-off down to like 270, and then it's going to take, 3, 4, 8 months for the stock to rebound back into the 300, and you're just sitting there, holding an overpriced, overpaid position. And again, technically, regardless of when you buy it, it does have a good chance to work out for you over the years and over time. But again, of course, we're all about pricing and timing. So that's why if we begin to piece our way in here at 370, and then if it does drop down, hey, look, it's at 350, I'm going to buy some more. Hey, look, it's at 322. Great, I'm going to buy some more. I started buying at 370, so it's at 322. I'll definitely buy some more, right? And again, that doesn't necessarily mean you were early, you bought at the wrong time. I know everyone always likes to immediately look at the negatives, but the positive you should be looking at is that you were accumulating shares, right? And the company is pretty popular and does have good positive recommendations, and the word is out, right? This is no longer an under the radar stock. There's a large cap company in the space that a lot of people keep an eye on, a lot of people own for the long term. Option traders jump in on earnings plays and whatnot, so it has a lot of attention, right? So that's my point. A situation like this, you can't get upset if you buy a little early or a little higher, because again, in my opinion, average your way in, lower that cost basis down, build a position, accumulate the shares. And again, the more shares you own, obviously the better. And down the road, if the company does happen to enact another forward stock split, obviously you're going to get even more shares because you have even more shares. But as we see here, quarterly, we have 2 misses on the EPS side over the last 8 quarters. 6 beats, 2 misses. We switch over annually, we can see we have only 1 miss going back to 2018, and it was by less than 1%. Other than that, the company beats annually on the EPS side. Quarterly revenue, same thing here. We have 3 misses and 5 beats over the course of the last 8 quarters. But if we switch over annually, we can see the company really, going back to 2016, has only 1 miss on annual revenue side, and it was by less than 0.4%. So, the 1 or 2 few times that they miss, it does seem to be a very, very slight miss, and they do come very close. So if overall we have positivity and beats and growths, then obviously any small misses, any small negatives, in my opinion, based on what we're seeing, could be viewed as buying opportunities, not necessarily as negatives. But looking at the forecast here for the company moving forward, we can see revenue expected here in 2024 up above 8 billion now, 25 9.25 billion. 2026 10.77 billion, 2027 north of 12 billion, right? Meaning that if they continue this trajectory, then chances are by 2028 they will be up to 14 15 billion, which, as you see, would be double the amount of revenue that they currently did for the year 2023. So from this point, again, if trends continue and nothing big or negative comes out about the stock over the next upcoming years, what this tells us is that from 5 years from now, it is basically forecasted that the revenue, the actual amount of business that this company is doing, is expected to double from this point over the next 5 years, right? And that's why, if we're looking for a long-term investment, that's the way you have to look at it. A lot of people, they'll say long-term, and because we're so used to trading options so quickly, something like a long-term hold, people view as like 1 month, 2 months, 4 months. That is not a long-term hold. You're still taxed capital gains short-term here in the States anyway. I don't know how it is internationally, but long-term hold is at least a year plus, right? But when we're talking about good growth over years with, of course, less taxes being paid, in something like a retirement account or something, what you want, in my opinion, is a situation like this. Because not only has the company been consistent and performing well over the last, however many years, more importantly, over the next 3, 4, 5 years down the road, we're expecting 30, 40, 80, 100% more growth from even this point. And that's why, in my opinion, those are the companies you should be looking for, which is why I wanted to make this video. And as you see here also on the profitability side, no expectations of slowing anytime soon. For 2023, the company posted $5.71 a share. For 2024, expecting $6.28. For 2025, $7.35. Look at this, $8.65, north of $10 a share by 2027. So the company, again, we could say, not only are we expecting revenue potentially to double by 2028, again, that's just my opinion, this forecast is not here, but also over the next 4 years, we're essentially almost looking for profitability to double as well. So that's why, even from this point here, we're talking about like a 70% increase in revenue, going from 7 billion to 12 billion by 2027, and we're going to have profitability almost double from its current point here in 2027. So that's what I'm saying. Over the next 3, 4, 5 years, this company, in my opinion, is probably just going to continue to grow. And I'm sure all the institutions are probably going to remain bullish on it and maintain their buy ratings and, consistently buy it for their clients and for their brokerage houses. But overall, we can see again basically every segment across the board. We did have occasional little dips here, but overall over time you can see just from 2016 alone, going from 1.4 billion up to over 3.5, going from sub 800 million, more than doubled it now to 1.68 billion. Even on the services side here, about $500 million. Now we're up to north of $1 billion, right? So a lot of these numbers have doubled and tripled over the last, 5, 6, 7 years, which is definitely nothing to sneeze at. Even though it seems like a long time, again, chances are if we fast forward 5 years, it does seem like a lot of time, but you guys will most likely still be maintaining, your small business or probably in the same career space, and you're probably still going to have an investment portfolio and still be looking for growth and newer investments, and you want to look back and see that you made some good decisions several years ago at that point, right? So that's why I always say, in my opinion, especially when you're talking long term like that, the fundamentals always trump the technicals. Technicals are for traders. Fundamentals, in my opinion, are for investors. But as you see here, even looking at, their business by country, you can see that here in the U.S., 2016 was sub 2 billion. Now we're up to north of 4 billion, right? So it's more than a double, more than 100% move. But look at outside the United States as well. This is, in my opinion, what makes a company even more valuable. And again, it's not just, I know right now we're looking at a company here in the States, but it could be a company anywhere, right? It could be a company out of the UK. And if they're consistently growing their business, we did 1 billion a year or two later. Now we're up to 2.2 billion. Now we're up to 4 billion. Now we're expanding outside of the UK. And now you see they start at 300 million. And then a couple of years later, they're at, 700 million. Then they're at 1.2 billion. What that tells you is it's not just a domestically fueled value company, value stock, right? This is something that the rest of the world appreciates as well and sees value in. So that's why something like outside of the United States revenue going from about $750 million up to north of 2 billion, in my opinion, is actually more of a massive green flag than just the more than double that we've seen in revenue here domestically here in the States over the last 5-6 years. So the fact that outside of the U.S. business has grown roughly 200% over the same time frame, I feel is definitely helping to drive this growth. But here, as we see, stock basically hanging around 370 a share. And again, in my opinion, we need to hold this top resistance trend line. So we're seeing a pullback here, maybe in the next couple of weeks to like that 356 level. And we can see we have our top fib line here at 356 and a quarter. So that's why, in my opinion, that's right around the level I would watch. And I would see if it decides to break this line, and we could have a potential gap fill maybe back down here to about 340, and we could retest down here to 320. But of course, if we bounce off and remain strong here, then we're going to 400 plus. And like I said, over time, we could potentially see 450, 460, 480, and we can touch this top resistance trend line up here. But overall, it does look good. Let's switch, random ad. Let's switch over to stock charts real quick, then I'll let you guys go. As you see, the RSI potentially could be viewed as tapped out, right? It's currently sitting here at about 69.3 and was well above 70 here for a couple of days going into these earnings, probably on high anticipation that, yet again, as they did, they were probably going to beat analyst expectations. So right now, with a situation like this, we could have something that is potentially stagnating, or more importantly, could just drop and begin to trade up and down into a consolidated channel, right? The stock could begin to consolidate and kind of bounce kind of up and down here in a downward channel, and then it could break out and take that next leg higher. So this is why I'm saying we could potentially begin to pull back here, like this mid-Bollinger Band, 349 and change. We could even retest these moving averages here at the low 300s. But again, this is why I say, in my opinion, you should always piece your way in, never go all in. And of course, especially if this is a longer term hold, yeah, it's going to suck if you buy at 370, all of a sudden it's at, 330, approaching this moving average. But again, if we liked it at 370, we're going to love it at 330. And if you're piecing your way in anytime the stock drops down and is discounted from where you originally started buying, you should be saying thank you. You should not be getting upset. But of course, that's if it's, a fundamentally sound stock as well. But as we see here, the MACD was climbing. Now with this up and down day, we could potentially have a curl taking place. And that's why I'm saying if we do begin to sell off here in a day or two and we pull back here into the 350s to retest that line, if we also have a high RSI up here still in the high 60s, potentially 70 plus, with a potential MACD meeting and about to cross to the downside, that's what I'm saying. That could potentially add to the sell-off here, and we could drop down into the low 300s. But of course, we'll cross that bridge when we get to it. Looking here on the weekly, we can see basically same thing, right? That RSI hit that 70 mark, and that's what I mean. It's like Wall Street, in my opinion, knows the stock should be higher, but technically they can't take it higher right now. So that's why I think it may just kind of cool out for even potentially like a week or two before it climbs back up here to the high threes and kind of like retest those new 52-week highs. But again, anything can happen, right? Stock could get upgraded again tomorrow by someone else and it can hit 400 and hit new highs. So anything can happen. But RSI here on the weekly still up here at 67, and we see the MACD kind of pulling away, consistently climbing. So we have to wait and see. But on the weekly here, you can see the low 300s and even this 50-day moving average here of about 300 and a third. That, in my opinion, should really be the low of the lows. And again, this is going to be, more of a slight correction, slight consolidation here that takes place in the stock. The problem is, again, it's on the NASDAQ. We've been pumping the NASDAQ to the moon. Everyone loves tech. People just consistently keep buying. We're no longer even looking at valuations, I feel like. People are just buying. You have stocks like NVIDIA just consistently climbing day after day. And if you look at all the other big tech names in the space, the ones who have that $1 trillion+ market cap, they have the revenue to back it up. They're doing hundreds of millions in revenue. NVIDIA is still doing tens of billions in revenue. So that's why, again, I know people are so pumped about NVIDIA, and if you own it for the long term, believe me, I am so happy for you. But overall, NVIDIA, I think it is probably hands down the most dangerous stock to own right now. That company could literally tank like 70%, and it would actually be 100% justified in my opinion. So, going off on a little bit of a tangent, but again, these valuations do seem a little bit high as we looked at the company doing a little over $7 billion in revenue with a market cap of $130 billion, right? So that's why I'm always a little hesitant when I do that market cap to revenue comparison. And a lot of people may not agree with that analysis, and I can appreciate that. But most of the time, it does work out how I say. And again, it's even for stocks that not only are undervalued, but companies, not only for stocks that are undervalued, but also for companies that are overvalued as well, as we saw what happened with a lot of the EV stocks that we looked at here on this channel, and stocks like Plug Power, Luminar, right? Laser, LAZR. That's what I mean. A lot of people the whole time that were selling off, they were like, oh, I don't understand. Why is this supposed to be hype? Or this is supposed to keep going. It's like, yeah, brother. It's like you have a company making a couple of dollars, and we're sitting here looking at a market cap of like 3.8 billion. Like, you know what I'm saying? That's why I always say what goes up must come down, and it eventually has to come back down to earth and come back down to reality. And of course, the timing is everything, but overall, like I said, if you piece your way into these situations and consistently add over time, your cost basis, I'm sure will get in line with stock prices, and before you know it, you're not going to beat yourself up for initially buying at a higher price. But I want to check the pivot points as well real quick, and then I'll let you guys go. Here on the weekly, we can see top resistance, resistance 1 is 389.40. And as we see, we hit everywhere I look, I'm seeing a different high for ISRG. But either way, that is probably the next line to hit right there, 389.40. So we'll see how quickly the stock gets up to that point and how it reacts. Of course, support level coming down is 306.03, so that's why I'm saying we could have potentially a big sell-off back down into the low 300s, but wait a minute. Oh, right. I was looking at the weekly. But here on the daily, we can see, look at this second level resistance here at 363.44. And you can see the stock dropped down to 362.14 and bounced right off of that resistance level and got back into the 370s and kind of has been holding that level for the last couple of hours, I believe. So that's why I don't know if they're going to drop it down below this resistance line, but the company did what they had to do, and they came out and they posted a beat. So only time will tell. But again, if I like it at 370 and we see a pullback here to 350 or even a retest here of the 50-day at 327 and 3/4, I mean, if I liked it at 370, I'm going to love it at 350, 330, But that's pretty much it. Overall, ISRG, again, in my opinion, looking pretty good. And we'll see if it can maintain this value and stay above this top resistance trend line. But I'm going to end it there. So once again, stocks by the numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky. They're volatile. They are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Y'all take it easy.